Let's talk about money, specifically your money and their money. Their money, of course, refers to the very rich, the ones who seem to conjure wealth from thin air. How do they do it? Well, a big part of it is faith, not the religious kind, though that can also be lucrative. No, this is faith in things like currency and the stock market. These things only have value because we all collectively agree they do. It's like Tinkerbell, but for billionaires. If we stop believing, the whole system could theoretically go poof. This collective belief system is a powerful tool. It's especially powerful for those who can influence that belief. Think about it. The stock market, that grand casino for the well-heeled, is mostly owned by them. The top 10% of American households own over 85% of all corporate stock. The top 1%, they own roughly half. So when the market goes up, guess who's really celebrating? It's not typically Brenda from accounting, unless Brenda has a surprisingly robust portfolio and a knack for market timing. For most, it's a sideshow, so the value of money in stocks is deeply tied to perception, and perception can be manipulated. Government actions, or even just pronouncements, can send ripples or tsunamis through these markets. This gives an incredible amount of power to those in the know, or those who can convincingly pretend to be in the know. They can leverage information, timely or perhaps even information, to make profitable trades. This, in turn, reinforces their already considerable financial standing. It's a lovely feedback loop if you're on the right side of it. This isn't some grand conspiracy theory, it's just how the system is often structured. Faith in markets becomes a source of immense power, and that power tends to concentrate at the top. The rich get richer not just by working hard or innovating or whatever bootstrapping narrative they prefer. They also get richer by understanding and exploiting the very mechanisms of belief that underpin our financial world. It's a game, and they often know the rules, and sometimes they even help write them, or at least get a sneak peek at the next chapter. Now let's zoom in on a specific period, a time when market faith was particularly jumpy. Enter former President Donald Trump, a man whose pronouncements, often delivered via his preferred medium of unfiltered digital shouting, could make Wall Street behave like a startled cat. His unpredictable policy announcements, especially concerning tariffs, caused significant stock market volatility. Investors were, to put it mildly, spooked. One minute everything's fine, the next a tweet declares a trade war, and the markets dive. It was like financial whiplash, but for everyone. Consider March 2025, a banner month for market mayhem. Trump's tariffs on imports from Mexico, Canada, and China were announced. The result? The S&P 500 index took a nosedive, dropping 5.8%. That was the steepest monthly decline since the festive season of December 2022. Happy new tariff. This wasn't an isolated incident, it was part of a pattern. A pattern of presidential pronouncements leading directly to market palpitations. It was less economic strategy, more economic shock therapy administered erratically. Then there was February 11th, 2025. On this day, Trump announced wide-ranging reciprocal tariffs. The markets, predictably, fluctuated. The term reciprocal sounded fair, perhaps, but the implementation was anything but predictable. Adding to the chaos, April 2nd, 2025 brought us Trump's Liberation Day tariffs announcement. This wasn't a celebration of freedom for most investors, as it led to a significant market plunge. It was a liberation from their recent gains, perhaps. The market seemed to be held hostage by the next policy win. These tariff tantrums, combined with arbitrary firings of federal employees and the sudden cancellation of federal contracts, created what experts generously termed economic chaos. One report in early 2025 noted the S&P 500 fell by a staggering 8% in a single month, directly linked to Trump's policies. It's one thing to say you're shaking things up, it's another to shake them so hard that everyone's fillings fall out, financially speaking. The market, it turns out, prefers a little less drama from its policymakers. Shocking, I know. So, markets are swinging wildly. Who benefits from this chaos? Well, not usually the average person trying to save for retirement. They tend to prefer stability. No, significant short-term market volatility, like the kind stirred up by Trump's tariff policies, can be a goldmine for a select few. These are the individuals who are able to anticipate these fluctuations, or perhaps more crucially, those who can react with lightning speed, and often those with a little information about what's coming down the policy pike. Given that stock ownership is so heavily concentrated among the wealthy, they are uniquely positioned. They stand to gain the most from market upswings if they get in at the right time. And just as importantly, they can protect their considerable assets during downturns if they have, say, a timely heads up. Imagine knowing a storm is coming before everyone else. You'd sell your beachfront property, or at least board up the windows, wouldn't you? It's the same principle, but with stocks and bonds, and often millions of dollars at stake. This isn't just about savvy investing, it's about access. Access to information, access to capital, and sometimes access to power. When the waters are choppy, those with the biggest, fastest boats, and perhaps a direct line to the lighthouse keeper, fare the best. Trump's policies created precisely these choppy waters. While many were getting seasick, a few were apparently enjoying some rather profitable surfing conditions. It's a system that rewards not just insight, but also potentially inside tracks. The narrative that a rising tide lifts all boats is often trotted out. But when the tide is as erratic as this, and some boats have advanced weather reports, it's a different story. The wealthy aren't just passive beneficiaries of market movements. They are active participants, and in an environment of high volatility fueled by unpredictable announcements, their ability to make swift, informed decisions, or decisions informed by things others don't yet know, becomes exponentially more valuable. For them, chaos can indeed be a ladder. Now, this is where things get particularly fragrant. We're talking about government officials, people entrusted with public service, people who, one might hope, are focused on the public good, not their stock portfolios. Yet, during this period of Trump-induced market madness in early 2025, a rather curious pattern emerged. More than a dozen US officials, their aides, and even members of Congress made some very significant stock trades. Trades that happened just before, or just after, Trump's market-moving announcements. Coincidence? Perhaps, or perhaps not. Let's look at Pam Bondi, the Attorney General. On April 2nd, 2025, a notable day. This was the day of Trump's Liberation Day tariffs announcement, the one that caused a market plunge. On that very day, Miss Bondi sold between $1 million and $5 million in Trump media shares. Timing is everything, isn't it? Selling right before an announcement that tanks the market related to the president who appointed you? That's either incredibly lucky or incredibly something else. It certainly raises an eyebrow or several. Then we have Sean Duffy, the Transportation Secretary. He was busy on February 11th, 2025, or rather, his broker was. Mr. Duffy sold shares in almost 36 companies. This flurry of selling occurred just 2 days before Trump announced those wide-ranging reciprocal tariffs. Again, what remarkable foresight. To divest from so many companies right before a major tariff announcement that could shake various sectors. One might think he had a crystal ball, or perhaps access to information not yet available to the public investor. And let's not forget Tobias Dorsey, a White House lawyer. Between February 25th and 26th, 2025, Mr. Dorsey sold shares in 9 companies. He also sold an index fund. This activity happened shortly before Trump announced tariffs targeting social media. A White House lawyer, privy to internal discussions, selling off stocks just before a specific sector-related tariff announcement? The optics, as they say, are not great. In fact, they're pretty terrible. It paints a picture that's less about public service and more about private profit. Section 5. More alarming trades, the insiders who knew when to sell. The list, unfortunately, continues. It seems the period before major tariff announcements in early 2025 was a very active one for the portfolios of certain well-connected individuals. Marshall Stallings, the Director of Intergovernmental Affairs, also made some interesting moves. Between March 25th and 27th, 2025, he sold stocks in Target and Freeport-McMoRan. These sales occurred just days before Trump's rather dramatic tariff announcement at the end of March, the one that sent the S&P 500 tumbling. Another case of impeccable or perhaps questionable timing. Then there are officials from the State Department. Stephanie Siptak Ramnath, for instance. Between March 24th and 25th, 2025, she sold between $255,000 and $650,000 in stocks. And what did she buy? Bonds and treasuries, typically safer havens when market turbulence is expected. This financial reshuffling happened right before the Liberation Day announcement. It's a classic move for someone anticipating a market downturn. The question is, what informed that anticipation? Was it public analysis or something more exclusive? Her colleague at the State Department, Gautam Rana, was also active. On March 19, 2025, Mr. Rana sold between a hefty $830,000 and $1.7 million in stocks. This was before Trump's new tariffs on cars were announced and also before the infamous Liberation Day tariff shock. Selling off such a large amount of stock just weeks before multiple market-shaking tariff announcements certainly makes one wonder about the information flow within the State Department regarding upcoming trade policy shifts. And it wasn't just executive branch officials. Representative Marjorie Taylor Greene also showed some interesting market acumen. In early April 2025, she bought between $21,000 and $315,000 in stocks. This purchasing spree occurred just before a Trump tariff rollback announcement, buying low, just before good news hits. That's the dream, isn't it? It's also the kind of dream that looks very suspicious when you're a lawmaker with potential access to non-public information about policy shifts. It's almost as if some people knew which way the wind was about to blow. Section 6. The stench of suspicion, ethical lapses and eroding public faith. All these conveniently timed trades by government officials, they stink. They stink to high heaven. Trading by government officials based on non-public information can and should violate the Stop Trading on Congressional Knowledge Act or STOCK Act. The problem, as always, is proving it. Proving that someone definitively traded on insider information is notoriously difficult. But even without a smoking gun conviction, the appearance of impropriety is overwhelming, and that appearance does enormous damage. It corrodes public trust. When people see those in power potentially enriching themselves based on information gleaned from their positions, cynicism festers. It makes the average citizen feel like the game is rigged. And honestly, can you blame them? If the people making the rules, or who are privy to the rule changes before anyone else, are also placing bets on the outcome, how can the system be fair? This isn't just about a few individuals. It's about the integrity of government institutions and the perceived fairness of our financial markets. Both take a massive hit. Ethics experts, bless their often unheeded hearts, have been sounding the alarm on this for ages. They advocate for stricter regulations. They suggest things like blind trusts or the independent management of investments for officials. The goal is simple: prevent conflicts of interest or even the appearance of such conflicts. It's about ensuring that public officials are focused on public service, not on how the next policy announcement will affect their E** trade account. This isn't rocket science, it's basic ethics. The failure to address these issues head-on leads to a predictable outcome: an erosion of public trust. Trust is a fragile commodity. Once broken, it's incredibly hard to repair. When the public believes that their leaders are more interested in feathering their own nests than in serving the common good, the very foundation of democratic governance is weakened. These stock trades, set against the backdrop of Trump's volatile announcements, became yet another symbol of a system seemingly designed for the benefit of a privileged few. Section 7. Wall Street's party, Main Street's hangover, the economic disconnect, so the stock market. Trump frequently pointed to its increases as definitive proof of his brilliant economic management. Look at the numbers, he'd bellow, and sometimes the numbers did go up. But here's the crucial question: is the stock market a comprehensive indicator of the nation's economic health? The answer, quite simply, is no. Not really. It's more like a scoreboard for a game that most people aren't even playing. Or at least, not with any significant stakes. It reflects a very narrow slice of the economic pie. The reality for most households is starkly different. The majority of people depend on wages for their income, not stock market returns. They care about job security, affordable health care, and whether they can pay their bills. The Dow Jones hitting a new high doesn't magically put food on the table or pay for a child's education if your wages are stagnant and your costs are rising. The stock market primarily reflects the interests of the wealthiest because, as we've established, they own most of it. It's their party, and the rest of us mostly just hear the distant music. Sometimes stock market strength can even occur due to factors that are actively bad for workers. For instance, if companies boost profits by suppressing wages or cutting jobs, the stock price might go up. investors cheer. But for the workers who lost their jobs or saw their paychecks shrink, not so much cheering. This creates a perverse incentive where what's good for shareholders isn't necessarily good for the broader economy or the well-being of the average citizen. It's a fundamental disconnect. Therefore, judging an economy solely by its stock market performance is like judging a person's health by the shininess of their car. It might look impressive, but it tells you very little about what's going on under the hood or in their actual life. The well-being of average households, their financial security, their access to opportunity, these are far more meaningful indicators of true economic health than the daily gyrations of Wall Street, especially when those gyrations are being influenced by unpredictable policy pronouncements and potentially exploited by insiders. Section 8, Policy Whiplash, Trump's Tariffs and the True Cost to the Economy. Despite the former president's boasts about stock market highs, when they occurred, his administration pursued policies that many economists viewed as distinctly anti-growth. The broad tariffs, a cornerstone of his economic agenda, and the threats of mass deportations ultimately served to weaken the economy and, yes, even the stock market in the longer run. It's a classic case of short-term noise, often self-generated, obscuring underlying economic realities. The market did have periods of growth, but context is key. For instance, the S&P 500 had risen a healthy 27% in the last year of the Biden administration, before these more disruptive policies fully took effect. This suggests a pre-existing positive momentum that was then subjected to the economic equivalent of a demolition derby. Experts like Loring Tu from Tufts University and Steve Hanker from Johns Hopkins University directly attributed the increased market volatility under Trump to his unpredictable policy announcements. Hanker specifically highlighted the damaging effects of regime uncertainty. Basically, nobody knew what was coming next, which is bad for business. The Federal Reserve itself, not exactly a bastion of radical thought, had to react. Due to the shifts in trade, tariff, fiscal, and immigration policies under Trump, the Fed revised its GDP projections downward. At the same time, it had to raise inflation expectations. To try and manage the situation, the Fed kept interest rates at 4.3% in early 2025, maintaining short-term borrowing costs. This isn't the sign of a booming, universally healthy economy. It's the sign of an economy facing significant headwinds, many of them self-inflicted through erratic policymaking. The narrative that Trump's policies were unequivocally good for the economy because the stock market sometimes went up is a gross oversimplification. It ignores the underlying instability created, the negative revisions to growth forecasts by impartial bodies, and the very real anxiety these policies injected into global trade and domestic investment. True economic strength is built on stability, predictability, and sound fundamentals, not on policy by tweet and governance by whim, which tends to benefit only those quick enough or informed enough to dodge the falling debris. Section 9. Beyond the bottom line, seeking real prosperity and restoring trust. So, what's the takeaway from all this? Trump's pronouncements, particularly on tariffs, clearly sent shockwaves through the financial markets. These shockwaves, while unsettling for many, created opportunities for the wealthy and, disturbingly, for government officials who made suspiciously well-timed trades. This isn't just about numbers on a screen, it's about the fundamental fairness and integrity of our economic and political systems. The rich demonstrably got richer, sometimes under circumstances that reeked of insider advantage. The ethical concerns are profound. When public officials appear to be profiting from non-public information, it erodes the already fragile trust citizens have in their government. It feeds the narrative that the system is rigged in favor of the powerful and connected. And frankly, looking at the trades made by officials like Pam Bondi, Sean Duffy and others around key tariff announcements, it's hard to argue against that perception. This isn't just a bad look. It's a potential betrayal of public duty, regardless of whether criminal charges ever materialize. Furthermore, the obsession with stock market performance as the sole barometer of economic health is deeply misleading. The S&P 500 can be booming while Main Street is struggling. Real economic well-being is about more than just share prices. It's about wage growth for ordinary people, affordable living, access to healthcare and economic security for the many, not just the few. Trump's policies, while creating volatility that some profited from, arguably did little to advance this broader vision of prosperity and, in some cases, actively undermined it. Ultimately, restoring trust requires more than just hoping for the best. It demands accountability for those who appear to misuse their positions for personal gain. It requires stricter rules to prevent such conflicts of interest in the first place. And it necessitates a shift in focus from the dizzying highs and lows of the stock market to the more steady, sustainable growth that benefits all segments of society. Because an economy that only works for the people at the very top isn't really working at all. It's just a gilded cage, and most of us are on the outside looking in.